Many people feel confident about how they manage their money, but the truth is, they might be following the wrong financial order without even realizing it. If you're focused on saving when you should be investing, or you start investing before building any savings, you're unknowingly putting your future at risk. This silent mistake doesn't make headlines, but over time, it can hold you back from reaching real financial freedom. So, what exactly is the difference between saving and investing? And why is it so important to use both at the right time? Welcome to FinTech Innovate AI, the place where we make personal finance easy to understand and your future a lot more financially confident. If you're tired of confusing money advice and boring lectures, you're going to love how we simplify everything that actually matters. Today, we're diving into one of the most misunderstood topics, saving versus investing, and how to master both for long-term success. Saving versus investing isn't optional, it's foundational. Let's get one thing straight. Saving and investing are not the same thing, and treating them as if they are can create serious problems in your financial journey. They may both involve money, but they serve very different purposes. One is designed to keep you safe, while the other is meant to help you grow. When you mix them up, you either end up stuck in fear of spending or stressed because you're not financially prepared for life's surprises. In this video, we're going to walk you through real-life examples, compare saving and investing side by side, and give you simple, actionable steps that you can start using right now to make smarter money decisions. Khan, what is saving and why you need it first? Let's start with saving, the most basic but powerful habit in personal finance. Saving simply means putting money aside for safety, stability, and easy access when you need it most. It won't make you wealthy overnight, and it doesn't offer big returns, but it gives you something far more important in the short term: peace of mind. Savings are there when life hits you with unexpected expenses, like a broken phone, a surprise car repair, or a sudden medical bill that needs immediate attention. You also use savings for short-term goals like taking a vacation, buying a new laptop, or paying for annual insurance, things that are predictable but still require cash ready to go. Think of saving as your personal safety net. It won't lift you up financially, but it will catch you when things fall apart, and that's priceless. What is investing and why it builds wealth? Now let's talk about investing. This is where your money starts working for you instead of just sitting still. Investing means putting your money into assets that have the potential to grow in value over time. Unlike saving, investing comes with risk. Markets go up and down, and there's no guarantee of returns. But with patience, time, and smart choices, investing becomes the most reliable path to long-term wealth. It's not about getting rich quick. It's about letting your money grow slowly and steadily through the power of compound returns. The earlier you start, the more time your money has to multiply. Even small amounts can turn into something significant. Some of the most common investment tools include stocks, exchange-traded funds, ETFs, index funds, and real estate. These assets can fluctuate in the short term, but over the years they tend to move upward, building real value. If saving protects your present, investing builds your future. And if you stay consistent, the results can completely change your life. Saving versus investing. What's the real difference? Let's break it down clearly. Saving and investing serve two very different purposes, and knowing the difference is key to building a smart financial life. Saving is all about security and easy access. It's where you park your money for emergencies, short-term needs, or just to feel financially safe, with little to no risk involved. Investing, on the other hand, is about growth over time. It means putting your money into things like stocks, index funds, or real estate, aiming to earn more in the future. When you save, your money stays safe, but grows slowly, usually earning between 1 to 5% per year in high-yield savings accounts. It's fully liquid, meaning you can use it instantly when life throws something unexpected your way. With investing, the potential return is much higher, often around 7 to 10% per year or more. But the value can fluctuate, and you need to be okay with leaving that money untouched for a while. So here's the simple truth. Saving protects your today, while investing prepares your tomorrow. It's not about picking one or the other. It's about using both together at the right time for the right reasons. Now, when do you save? When do you invest? So here's the big question. When should you save, and when should you invest? Understanding the timing makes all the difference in how your money works for you. You'll want to save when you're planning for short-term expenses, things you expect within the next 6 to 12 months. That could include rent, travel plans, medical bills, or emergency situations that pop up without warning. Savings are for the moments where you can't afford to lose a single rupee. You need your money safe, stable, and instantly accessible. And that's exactly what saving gives you. Now let's flip to investing. This is for your long-term goals. Things like retirement, buying a house, or building passive income streams that take years to develop. Investing works best when you won't need the money for at least 3 years or more. That time gives your investments room to grow and recover from any short-term market dips. Bottom line, savings give you stability today. Investing gives you freedom tomorrow. You need both, but you use them at different moments for different missions. Let's say you're doing well and have $500 left over at the end of each month. What should you actually do with it? If you save all of it, you'll have a strong safety net, but your money won't grow fast enough to beat inflation or build wealth. If you invest all of it, your future might look promising. But what happens if your car breaks down next week or a medical bill shows up? Here's the smarter approach. Split it based on your goals and current situation. For example, put $300 into savings to strengthen your emergency fund and invest the remaining $200 for long-term growth. This way, you're not choosing between security and strategy. You're building both at the same time, one smart step at a time. How much should you save versus invest? So how much should you actually save and how much should you invest? There's no one-size-fits-all formula, but here's a practical starting point to guide you. Try following this basic breakdown. Save 20%, invest 30%, and use the remaining 50% for your lifestyle and living expenses. If you're just getting started, your first priority should be building a solid savings foundation, ideally enough to cover 3 to 6 months of essential expenses in case of emergencies. Once that's in place, start shifting more money toward investing. Over time, this will help you grow your wealth while still feeling financially secure. And remember, it's not about hitting big numbers overnight. Consistency matters more than the amount. Staying steady is what builds real progress. The best tools to get started for savings. Start by opening a high-yield savings account. These offer better interest rates than regular banks. Platforms like Marcus by Goldman Sachs, Ally Bank, or even some local credit unions provide solid rates with no monthly fees. To stay in control of your money, try budgeting apps that make saving easier. Apps like YNAB, You Need a Budget, Rocket Money, or Good Budget help track expenses, set goals, and build healthy money habits. These tools make sure your savings are intentional and organized, not just whatever's left at the end of the month. For investing, if you're a beginner and want something simple, start with apps like Acorns, SoFi Invest, or Stash. They allow you to invest with small amounts, offer educational content, and automate the whole process, ideal for first-timers. If you're more confident and want full control, try DIY platforms like Vanguard, Fidelity, or even Robinhood. These give access to a wide range of investment options, but require you to do your own research and make informed choices. A quick tip: Robinhood might be trendy, but it's not beginner-proof. Only use it if you're confident in what you're doing. And use both. Build wealth and peace of mind. When it comes to building real financial freedom, it's not a question of saving or investing. It's about knowing how to use both to your advantage. Saving keeps you grounded. It gives you peace of mind, a sense of control, and the ability to handle life's unexpected moments. It's your financial foundation, the thing that keeps everything else from falling apart. Investing helps you rise. It takes you beyond just surviving and opens the door to long-term wealth, growth, and possibility. It's how you get ahead instead of just keeping up. Most people believe they need to choose one path: safety or growth, saving or investing. But in reality, the smartest money strategy blends both, intentionally, consistently, and with purpose. If you want to build lasting wealth and live without financial stress, don't pick sides. Use both wisely. And let your money serve your present and your future. Are you currently focusing more on saving or investing? And why? Drop your thoughts in the comments. We genuinely love hearing about your money goals and personal finance journey. If this video helped you simplify the confusion, make sure to hit the like button, subscribe for more weekly insights, and share it with someone who's just starting out.